Hi, I'm Owen from Rask Australia. Thanks for tuning in to the Rask Network. Before we get into today's show, there are a few things we have to go over. Firstly, what you're about to hear and see is limited to general information only. It's not personal financial advice like you'd get from a financial planner. Also, it's important to remember that past performance is not indicative of future performance. That means that anything that's happened in the past, or we say today, is not necessarily going to reflect what happens in the future. Lastly, please consider that any of the guests or myself are featuring on this program may have a financial interest in some of the products or shares mentioned. That's enough from me. I hope you enjoyed today's program. Welcome to this episode of the Australian Finance Podcast, and we are doing a special episode where we've
part of Shares Month.
As part of Shares Month, where we've got guests in with us. We've got Catherine Go. Catherine, welcome to the show.
Thank you. Good to be here.
It is indeed. And we're going to be joined by Raymond Jang remotely, who is another Rask analyst. He'll be bringing us three of his company ideas as part of Shares Month. And we're all going to contribute some ideas to this podcast. We're going to bring three to the table each. I think, Kate, it's important to know that these ideas are just kind of ideas. Maybe put them on your watch list and go about all of the, research in your own time using the skills that you've learned throughout Shares Month.
Yeah. So we're bringing you a lot of different experts and suggestions during the month on how to research companies, and as well on the Investors podcast recently, you've been running for a 12-part analyst bootcamp, which really covers the foundations. And these are essentially today we're bringing you 12 different ideas that you can actually put your skills to use on and actually have a go analysing different companies, researching them, getting a bit of background information. Maybe you've just taken the Get Started Investing course. Maybe you're enrolled in Owen's Value Investor program, but just 12 different ideas. They're not necessarily companies we own or that we've put a recommendation on, just different ideas for you to have on your watch list and start researching. Yeah, so we did this last year, and Kate, you hit the nail on the head there. These are ideas that we're hopefully going to give you so you can put them on your watch list in your brokerage account or wherever you track your investment ideas. And then from there, what you can do is you can go ahead, listen to the rest of Shares Month, or jump across to the Australian Investors podcast, where we've got a free download as part of our Investor Bootcamp series. It's a gigantic Google Doc that includes a whole heap of resources, and you can run through that series as well if you really want to go deeper into the companies. The companies that we named today, we're going to have ticker codes. We're going to tell you the name of them. You can head to their investor relations department on their website, access their annual reports, and start reading about the companies too. Yeah, and they're all companies that we've found interesting in one manner or another, whether we own them or not. So they're worth having a bit more of an explore and using the downloadable checklist as well, which will be in the show notes that we ran through in the first part of Shares Month. Yep. So this is a really good interactive session because you'll be able to take the companies and then go ahead and use all those resources in your investing. So and we'll also include in the show notes if we own any of these companies as well.
Full disclosure. So maybe what we'll do is we'll start off with just a quick question to the two of you is how long have you been investing? And I guess for you, Catherine, I'll get you to explain your role. So maybe we'll start with you. How long have you been investing and what do you do at Rask?
So I've been investing for around 5 years now, and my role at Rask is primarily to focus on smaller companies, so say below $1 billion in value.
Yep. So these would be companies primarily on the ASX.
On the ASX, yeah.
Yeah. Cool. Nice. And Kate, how long have you been investing?
Well, I've never been an analyst, so I'm coming at this from a different angle, but I've been investing in some way for about 7 years, investing properly, maybe for 5 years. The first couple of years were just pure experimentation. Most of the things I do not own today. But you need to go through a bit of that in your journey.
For sure you do.
We all do.
And I'd say I've been investing for more than 10 years now. Obviously showing my age here a bit. And
so you've seen some things.
I've seen some things. I've been places, Kate. And so basically, I've evolved my investing over time too. And we're going to talk about that today. But first, before we get into our three ideas that three of us are bringing to the table, we're going to cross to Raymond Jang. Raymond's in Sydney. He joins us. He's an investment analyst for our Rask Invest service. So welcome to the show, Raymond.
Yeah, sure. Thanks for having me on, guys. Glad to be here. So my first company off the block is Alphabet. So Alphabet's the name of the holding company that represents a collection of companies. I think all of you know and everyone knows that Google is one of the biggest companies as part of Alphabet. And I think everyone's quite familiar with the alphabet. I mean, it's a collection of letters. And that was the main reason why founders were quite passionate about. They thought it was one of the most important innovations in humanity. So, and it also forms a core of the index of how we search on Google. So that's one of the main reasons why it's called Google. Yeah,
because there's another thing to that, right? Like they had one company that they owned for every letter of the alphabet too, right? Like they had so many companies under the master company.
Yeah, that's right. I think another, well, not reason, but another fun fact is that, alphabet, the first half of the word means outperformance of the benchmark, and then the second half of that word is bet. So it's quite an appropriate name for a company that's listed.
I didn't know that.
No,
That's
never
pretty
thought
cool.
about
That's
that one.
Cool. Yeah. So you mentioned before that Google makes up the most of it. So Google meaning like, the internet search engine. When you type something in Google, they make money.
Yeah. Essentially, you hit the nail on the head with that one. So when you talk about Google, I think it's great to see a very powerful and very simple mission. When you read it, it essentially says its mission is to organize the world's information and continuously make it more universally accessible and useful for people. And when you think about that, it's like very, very easy to understand, very simple, but it's doing a very powerful thing, right? When you think about Google search, you're trying to look for things. You're looking for information, recommendations, to find products. You've got YouTube. You're trying to look for funny videos to entertain yourself, or you're trying to learn a recipe. You go on YouTube. You try and find places, Google Maps, and then you're storing and saving documents, Google Drive, Google Cloud. So it goes on and on. And those are putting a lot of money into to develop a self-driving taxi service to make us even more lazy.
Is that the thesis? We're just inherently lazy.
Yeah, I think Google helps with that. It's becoming more ingrained in everyone's lives. And that's pretty much the main reason why I think Alphabet is likely going to be a long-term compounder, because it's so relevant to everyone's lives, and we're so reliant on it. I mean, when was the last time your friends or your parents asked you something and you had to Google for it?
Yeah.
This morning.
Yeah, this morning. Yeah. It's crazy, right? Because it is so dominant as well. There are other search engines, but everyone just defaults to Google, right? You can use anything else, but it's just so cool. So that's a really what we would say wide moat company, right? Like it has a really thick competitive advantage. What would you say is the main risk to Alphabet?
When I think of key risks, with the upcoming rising inflation and high interest rates, I think it's going to have a massive dampener effect on advertising spend. And advertising spend is still makes up a majority of Google's revenue. But in saying that, Google's still on the top of the advertising value chain, in that they control the ecosystem. So a lot of businesses, content creators, even our business is kind of reliant on Google. So that kind of showcases how powerful Alphabet is, or Google is. Yeah, the other key risk I would mention is as Google becomes more relevant to people's everyday lives and becomes more powerful and has that monopoly, I think that attracts more media scrutiny. And it's already in the media a lot of the time, but it does. There's a greater risk of more regulation.
Yeah, we see that in times gone by. Like Google has been fined all around the world, basically, for different things, and we saw it 12 to 24 months ago here in Australia. Google and Facebook were the center of political debate around what is news and how is news going to be regulated. So that's one of the biggest companies in the world, Raymond. I feel like some of our listeners might be thinking, oh, I wish Raymond brought a company that they hadn't heard of or hadn't seen today. So what's the next company? You've got 3 for us. What's number 2?
Yeah, number 2 is definitely more obscure compared to Alphabet and Google. It's a company called, it's got Alphabet, it's got letters in it as well. So PWR Holdings. So PWR It develops cooling solutions and products for really high-end vehicles, and it provides this to 4 key segments. Its bread and butter is motorsports. So when you think of motorsports, you think of F1, the FE, which is the electric vehicle version of the Grand Prix, the World Rally Championships, your V8 supercars, all those sports races. And all these vehicles, they get really hot and you need to cool down sometimes. So it's like when you go for a run, you sweat up and you cool down. And that's what PWR provides. In terms of the second segment, so sells similar products and solutions, but to everyday people. And I'd say, when I say everyday people, I'd say those people would probably take more care of their vehicles than the majority of the population, and really value the quality of PWR's products. I'm not sure if any of you are rev heads. I don't think so.
Maybe Kate. Kate would probably be the closest to a rev head in the room. Actually,
0 to 150.
It's funny because between the 3 of us here, there's only one car.
And we all share it.
Yeah. But you never know. Like, we could be in the market for a new radiator for our car.
Yeah, it's interesting because I actually asked one of my mates who is a bit of a rev head, and he actually takes his car to the racetrack every now and then, and he straight away he knew who PWR was, and he said, he wasn't sure why I was asking, so he was actually worried that I was spending too much money on some cooling solutions for my own car.
So what would you say then, like we talked about the risks of Alphabet, what would you say are the risks to PWR?
In terms of risks, I'd say valuation at the moment is quite high. Price to earnings is around 42 times. And to give some context, I think the average price to earnings for the biggest 500 companies in the US is around 15 times. So to view in that light, you'd say that PWR is quite at a premium in terms of the share price and also the multiple. And there's I think there's high expectations built into current share price. And I think another key risk would be the rise in raw material costs. The biggest raw material cost is aluminium. So all these cooling products, they're like rectangular, they're like blocks. And they're all made of aluminium. And at the moment, aluminium prices is at record highs. And it doesn't seem like it's going to abate anytime soon. And it's branching outside of motorsports. So the key driver of growth for PWR is actually providing the same solutions and products to military defense and also aerospace, which is very interesting because company that we talked about before, Alphabet and Google, they're trying to build infrastructure in space to improve the efficiency or the speed of the transmission of data, essentially to improve productivity. And to get to space, you need to build some more spacecraft. And that's where PWR comes in and provides cooling solutions because it kind of gets hot up there, as they say.
Okay, so as everything gets hotter, PWR gets more interesting. And it's also good that you brought up the price to earnings ratio. It's what we spoke about recently in a Jargon Buster, because and the way you talked about it too, having a high price to earnings ratio, or PE ratio, and you can compare that to others like in the whole market to get a sense of what investors, like the value that investors place on the company's profits. So that's really interesting, mate. So PWR, we've gone from Alphabet to PWR, which is a much smaller company, but now I think we're going to go smaller again with your last name, which is a technology company. So tell us about this business. I doubt many of our listeners have heard of it.
Yeah, my last business, so I'd say it's my strikers, my wingers, my attackers in my soccer team, of these 3 stock portfolio. And I'd say Janison is very small company and also very high risk, but there's a lot of growth going on at the moment. So what does Janison do? It's essentially trying to be the leader of digital and physical educational assessments provider for infants and secondary schools in Australia. So it charges schools as well as corporate organisations to access its education platform to either complete assessments or upskill. The interesting thing about Janison is that compared to other assessment platforms, it actually holds a contract with the Organisation for Economic Cooperation and Development to provide and roll out the program for international student assessments for secondary schools across a number of countries, not just Australia. There's quite a few jargon in there. So I think OECD essentially is trying to lift the standards of education, but it's not the only thing that they're trying to do. They're trying to lift the quality of life and other aspects of that are important to human beings.
So it's more of a technology company, and it provides it does like proctoring and exams, whether that's digital or physical. And I think you told me once that one of the things that they're trying to do is like when you have an exam, like during COVID, or even just a remotely assessed exam, they might be able to monitor like the eye movements of a student to see what they're looking at, to make sure that they're looking at their screen and not looking at notes or other students' work and things like that.
Yeah, that's right. When I was listening into the call, I found this technology to be quite unreal, to be honest, because I've been accustomed to sitting on my exams physically and haven't really done a test digitally. And for a camera to be able to pick up your movements and what you're doing, and also the movements within the room is quite amazing. And I think I just wanted to expand on that international student assessment. That assessment's not trying to develop your standard scorecard and benchmark or league tables within schools, but it's actually trying to help students build real life skills, so to improve their critical thinking skills and also emotional intelligence skills.
So Raymond, that's an interesting thing. How does it do that? Like, how does it, like, so what is it, they're not setting the test necessarily, or are they setting the test? Like, how does that work?
So in terms of the actual platform, they're trying to formulate questions where they're assessing a student's ability to deal with certain situations and what they would do in certain case studies, and also assess their emotional states as well, and trying to provide examples or tests that can really show them what's the right way to approach everyday tasks. So I think a lot of people can relate to first starting out as a graduate, and then I think communication skills is very important, and emotional relationship building skills is very important. So it provides guidance on that.
Right. So this is, as you mentioned, this is a company that trades on the ASX under the ticker symbol JAN. So it's a smaller company. So this is what we call small cap, which sometimes comes with more volatility, the ups and downs. If they don't meet, certain performance metrics for profitability or whatever, they don't. I guess they get punished. The share prices can be volatile. So Raymond, what would you say are the risks aside from just like that general up and down that share prices tend to exhibit? What else would you say is a key risk for Janison?
Janison's scaling at the moment, and they're rolling a lot of those assessments and programs across the globe. So I think the key risk at the moment, or over the next 5 years, would be the ability to scale and to keep those employee costs down, because at the moment that's probably the biggest operational costs that we're seeing with the rollout of all these assessments, and especially the program for international student assessment.
Yeah.
And in terms of the other key risks would be a shortage in skilled labour. I think that's been a key topic of discussion of late, and it applies to Janison as well, because they're trying to optimise and improve the platform, and that requires very technical software engineers to do that over a long period of time.
Yeah. Well, Raymond, those are three really interesting companies. So we've got Alphabet, which we all know. We've got PWR Holdings, if I'm not mistaken.
Which cools you down.
Yeah, it cools you down no matter where you are in space or on the racetrack or even just driving to work. And that trades under the ticker symbol PWH. Is that correct? Yeah. So that's an important thing, because if you're listening to this and you go into your brokerage account and you type in PWR, that will come up with a different company. So what we're after is the company called
Peter Warren Automotives.
Yeah, so we're not saying Peter Warren Automotive.
So they're both car companies.
They're both
so
car
that could
companies.
be a bit confusing.
Yeah.
They're both car companies. So we're saying PWR Holdings, which trades under the ticker symbol PWH. That's the one you want. So add that one to your watch list. And then finally, we had Janison Education, which is a software company that is also is involved in remote proctoring of exams and trying to lift educational standards across the globe. So Raymond, you've come up with 3 really interesting companies, all with a kind of tech and I guess more modern approach on whatever industry they're in theme. Really interesting companies that people will be able to track. So thanks for taking the time to join us from Sydney.
Thank you. And just for full disclosure, I own shares in Janison, but I don't own shares in the other 2 companies, PWR Holdings, and Alphabet.
Yeah, great. Thanks, mate. And good disclosure, that will be something that's included in all of our show notes, and we will make note of that throughout. I do own shares in Alphabet. Does anyone else own shares of Alphabet? Probably, says Kate. We'll have to check
we'll
that
confirm
and check in the
show
show notes. Once again, Raymond, thanks for joining us, mate.
A pleasure. Thank you.
So now we're back in the studio, and thank you for joining us, Raymond. We're going to talk about our 3 ideas each. We're going to go through them each, all 3 at once. So I'm going to start with my 3, then we might cross to you, Kate, for your 3 ideas, and finally to you, Catherine. So my 3 ideas are a little bit kind of different to last year. Last year when we did this series, I talked a lot about Washington H. Soul Pattinson, and some listeners wrote into me and said, "Oh, Owen, that invests in coal." And there's been a few things that have happened on that front. And there were a few other companies in there. I think I did one ETF as well. This year I'm going to mix it up a bit. And the first company that I'm going to name is MFF Capital, and this trades under the ASX ticker symbol MFF. And this is what we call a listed investment company, or LIC for short. And basically all it is a company that invests in other companies. Now, what makes this one interesting is that this LIC is actually very low cost, and it's run by one of the co-founders of Magellan Financial Group. So if you want to check out the MFF Capital website, where you go is you go to the Magellan website and then you click through to the website. It's kind of hidden off to the side. And this is a bit different, because when you invest in this company, what you're effectively getting is ownership of a company that then takes money that it's got inside of it and goes invest in other companies. And it invests in a minimum of 20 companies that are resilient, have competitive advantages. So these are the things that we've talked about, and they trade at a good valuation. Now, what is really interesting about this is that the co-founder of the company, of Magellan, is the person that runs this. His name's Chris McKay. Now, he's a fantastic investor in his own right, and he's a huge investor in this MFF Capital company. And why that's interesting is because people sometimes say that this is basically just his personal investment company. It just happens to be on the stock exchange, and you can get access to it very cheap. One of the things that I like about this listed investment company is when you invest in it, normally when you invest in an overseas way, so let's say you go and invest in an ETF that invests in, say, the NASDAQ or the US share market or whatever, normally when you invest over there, you don't get franking credits. So you wouldn't get that tax benefit if you earn dividends. But because what you're actually investing in is an Australian company that then invests overseas, the Australian company pays tax, so it generates franking credits. So you get the benefit of, 1, having a great investor at the helm, 2, franking credits and regular dividends. They have a commitment to paying regular dividends. And 3, you get international exposure. So it's kind of just a sweet spot for all of those. And so what's included in the ETF, in the listed investment company, I think is a good way to demonstrate what they do. So inside the portfolio as of April 2022, it had Visa, MasterCard, and right down the bottom is a very small holding. It had L'Oreal Group. So you get a flavor of the types of companies in there. They're very well-known, very resilient, and long-term focused. So that's MFF Capital, and it's a little bit different. A lot of people probably didn't expect me to say something like that, but I think with a good management team, investing in competitively advantaged companies, diversification, it's a pretty good one. Does anyone own that?
I own that.
You own it?
I do own that,
Catherine,
yes.
okay. How many stocks or ETFs are in your portfolio? I don't guess.
Guess, including US shares, probably around 50. 50.
50, right? Okay, yeah, no shame there. And Kate, how many do you reckon
No
you're
comment on that one.
Kate's got a bigger number than I do. Let's just say that.
Okay.
I don't think that answer will help anyone.
Okay. That's perfectly all right. That's fine. And some investors choose to go about it that way. We've talked about this on the show before. Some investors tend to build a big portfolio, others be very concentrated. I'm definitely more concentrated than that, but that's okay. My second company is a company that many people will know, particularly if they're fans of the tennis. The company is Salesforce. Now, this trades on the New York Stock Exchange, so the NYSE, and it's under the ticker symbol CRM, which for most people, you would know that stands for Customer Relationship Management. And the company itself, Salesforce, is a software company for that. So it started as this core service that allowed you to manage your customers, whether they're coming from a website, whether they come in from social media, whether they physical stores and the customers come in and they put their information into the system. It all integrates into this backbone called 360, and it gives you a 360-degree view of your customers and basically your entire business. Now, what Salesforce has done over the years is it's really innovated within its business to bring more features and widgets to people. And it's sold on subscription and it's not cheap. So if you use Salesforce for your business, it might be like a minimum cost of like $200 US a month. But now what they've done is they've expanded well beyond just conventional, customer relationship. You can do full automation. So you could send text messages, emails, you can capture all signups and take payments and all this type of stuff. And they've also moved in a big way into analytics through one of their businesses is called Tableau. And another one, which they bought recently, the biggest acquisition that they've ever made is Slack. Now, Slack, you probably know if you work in a business, it's like Discord for businesses. And what was actually fascinating about this is the deal to buy this company, which off the top of my head was $37 billion. I'm looking at Catherine. She doesn't know. I think it was about $37 billion. And what was fascinating about this is Slack was actually using one of their new features to do the negotiation with Salesforce, where you can add people from outside of your business into Slack and you can do and they were just doing a negotiation inside Slack. So it was basically a big play, a big push by Salesforce to say, we do customer relationships so well. How about like team stuff and management of teams and helping customers talk to employees? And so that was Mark Benioff, the CEO's basically vision for Slack. And what Salesforce has done is got these verticals across like the full stack of business automation. And it's effectively taken them and turned each of them into billion-dollar businesses by themselves, so $1 billion of revenue. And the business grows like clockwork at like 20 to 25% a year. It's got really good margins. It's not like super profitable right now, which is something that catches people off guard. And that's because it's continuously reinvesting into its business. But it's not the type of business where like it's never going to reach profitability. If it wanted to, it could. So that Salesforce trades under the ticker symbol CRM on the New York Stock Exchange. So if you have an international broker, you would be able to add this to your watch list. And does anyone own that?
I own that, yes.
You own. Okay. That's 2 for Catherine.
I've used it as well as a
I have
customer.
Yeah. Okay.
Yeah. And it's very, there's whole thousands of employees that are called Salesforce specialists that organizations employ because it can get so technical in the back end. And once you're integrated into it, it's very hard to detach it from the company.
Yeah, that's right. So it's got what we call switching costs. So
it's like a limpet.
Yeah.
Like once it's stuck on the rock, you're not getting it off. Okay, it integrates.
So there's actually one of those Salesforce specialists in our shared office here. And they actually were so good at their job. When this company here outside our studio brought them into the office, they worked from the office 1 or 2 days a week. And then they employed them. Because they're like, well, you're so important to our business, we need you.
Yeah.
So that was really fascinating. So that's my second company, which is Salesforce. CRM is the ticker symbol. The final company is perhaps the most boring, which is Wesfarmers. It trades under the ticker symbol WES on the Australian Stock Exchange. So ASX WES. Now, most people would have heard of the brands underneath Wesfarmers, but if you're new to investing, you won't know the company itself. So Wesfarmers has been around for decades, and it owns Bunnings, Kmart, and a bunch of other little things like Officeworks. In the past, it owned Coles for quite some time, and now Coles is separately listed on the ASX. And it also owns some businesses that are involved in industrial type things, so like fertilizers and manufacturing and that type of stuff. And the whole idea of Wesfarmers is that, like the first company I mentioned, MFF Capital, it's kind of a company that holds other companies. But the difference with Wesfarmers is Wesfarmers buys them outright, typically. And it buys them outright like it did with Bunnings or Coles for a period of time, improves them, and then kind of recycles them back into the stock market. They might sell them to another investor. So in the case of Coles, they bought it when it was really struggling. Its profit margins were like below 2%. Then they brought it back to 4% or 5% profit margins, and then put it back on the stock exchange and sold it for a higher price than they paid for it, while also taking dividends along the way. So that's kind of their MO. And why would you buy Wesfarmers, or why would you have it on your watch list? I guess the simple things are, over time, even though it's like the Titanic, how big it is, and it seems to be slow moving, it does every year grow a little bit. Like, even though you think of Kmart, you think, oh, this thing's like, it's been around for decades. It does grow a little bit every year. Same with Bunnings. Like, every year, Bunnings rolls out another 1 or 2 stores or whatever, and every year those stores add to the revenue, and it just gets more and more scale and gets more and more important. Might not be every year, but that's basically how you can think about it. And so you get that slow, long-term compounding, but you also get dividends and franking credits along the way. And that shouldn't be understated because the benefit of that is it does pay like a really impressive yield, a dividend yield. You'll get that half yearly, and you'll get the franking credits when tax time rolls around. So combined, those two things, if you can buy Wesfarmers shares at a reasonable price, they're probably like fully priced at the moment, is what I'd say. So it's more one for the watch list. But if you can buy them for the right price, it's a pretty good business. So any questions on my 3 companies?
Sound all interesting ones to have a bit of a research of.
Yeah, I wanted to be quicker than Raymond in my 3 companies. Now, I trust you guys will be a bit quicker, but those are 3 companies that like they might sound a bit like, oh, we know this name, it's been around forever. I was hoping you'd come up with something that I'd never heard of. But these are companies that, in a market where inflation, as Raymond said, might be a little bit higher, I think these 3 companies have the ability to slowly but surely add value to shareholders.
And all those Bunnings sausage sizzles.
Well, the Bunnings sausage sizzles, yes. That's the only reason you should buy Wesfarmers shares. For every $1 that you buy, or $2 that you spend on a Bunnings sausage sizzle, you could put that $2 into Wesfarmers shares. You'd probably be wealthy. Yeah. Okay. So just don't slip on the onions. Kate, now we're going to switch to you. We've got you giving us 3 ideas, 3 of your biggest and boldest ideas you've ever come up with as a fully fledged senior chief economist analyst, co-host of one of Australia's biggest podcasts. Yep. God, you must be good at this stuff. So, Kate.
Well, I've got 3 ideas for you. Whether they're fantastic is debatable, and I have not looked at the financials, so I'll be very clear about that.
So Kate's are more like, these are ideas, go away and research them. Like we're introducing an interesting business in each case.
Yeah. I mean, the general premise of each of the companies intrigues me.
Okay.
So, did you know that 40% of all relationships in the US begin online now?
40%?
Yes.
Of all relationships?
In the US.
That's got to be.
Begin online.
Right. Because I remember seeing a statistic not too long ago of 1 in 3 millennials met online when they got, if they were married and they did a survey. 1 in 3. So now it's it's more than that. It's
pretty high.
Yeah.
And a lot of people have met using apps like Hinge, Tinder, OkCupid, Plenty of Fish in the US.
Okay.
There's a lot of these companies. And if you've heard of any of these names or used them, they're all owned by the Match Group. Which is a US company listed on the NASDAQ. And the code is MTCH.
MTCH, okay.
And they are an owner of all sorts of dating companies, of all types of dating companies. I just listed a couple there, but there's at least 20 different ones. They often buy them or they create them. But it's been around for a long time, since 1980s. There's over 2,000 employees at this company, over 20 offices. The CEO has been running the show for a long time. And there's over 100 million active users at the start of this year.
Imagine if you could say 1 in 4 of my customers, met each other through my business. That's pretty cool.
They're in the business of love.
They're in the business of love.
What other investment case do you need, Owen?
And we are now in the investments of love.
Yeah, and the company is starting to launch in non-English speaking countries. there's a few
That
interesting...
would be important. I imagine there are a few people that don't speak English that would like to meet.
The way that the company makes money is through people often paying in-app purchases or subscriptions. So they usually work on a freemium model. So you can use the app for free or the dating site for free, but you can also pay extra for the different perks to message people or extra special profile features or to match with more people.
So you said match there, pun not intended. So basically what might happen is if you go into Tinder, for those people that don't use it, you might get some like ability to find someone, but you might only get like 5 opportunities before you then have to pay for the next package, which then gives you more access, basically.
Yeah. So there's lots of different types of in-app purchases, which is another something on the risk side of things because they are dependent on things like the App Store on Apple and Google, and they've been having a battle with that recently because that takes quite a bit of a cut out of their revenue.
Yeah,
because people older customers still go to websites to do online dating, but young people just want to use the app and they only want to use in-app purchases. So that's a bit of a risk there about that. And I think there's some big court cases in the US at the moment about Apple having the monopoly over the App Store and in-app purchases.
Yeah. Yeah, Catherine's nodding her head for those of you that aren't watching on YouTube. So basically, Match Group owns this collection of companies that then provide dating solutions, basically.
Yeah.
Whether you're on the phone, I think Tinder's the number one lifestyle app globally for revenue, I believe.
Yeah, it was the number one downloaded dating app worldwide, according to their data. And it was also the highest grossing lifestyle app because dating's part of your lifestyle now.
It is part of your life, I guess.
And it was interesting. They, according to their internal surveys, so always with a grain of salt, but they say that 60% of all relationships that started on an app in the US started on one of theirs.
Because there are other apps like is it
Bumble?
Bumble, yeah. That's because I remember when I looked at. So
there's a bit of backstory there with the founder of Bumble and Tinder.
Yeah. And this is one of the things that I looked at. I looked at this company quite a few years ago. Wish I bought shares, by the way, but I didn't. They were owned by a company called IAC. And that company, IAC, spun them out, meaning that they sold them separately to the stock exchange. And at the time, I was like, oh, this is like a bit weird. I don't want to have share in Tinder or Match Group when most of it's owned by some other company I don't want to have exposure to. But at the time, this is when like Tinder was really hitting its stride, but Bumble had just started. Yeah. So I was like really worried. I was like, is everyone going to switch? But it seems like people still use those core dating apps.
Yeah, well, they're still growing. And even some interesting stats. They did a Singles in America study with 5,000 participants last year. And they were saying that 1 in 4 singles had a video date before meeting in real life. So people are actually using these apps and then actually having video dates and chats online before they actually take it in real life, which is quite interesting. And Gen Z, 51% were having video dates before meeting in real life. So they're really trying to, and they're even apps like Hinge, they're adding audio prompts, they're adding like in-app video features. So they're really using technology to the best of their ability to enhance dating online.
Because one of the things that would no doubt concern people when you're going through an app is like, you really only get profile pictures, that whole catfish. There's entire, a series about this on, different streaming services.
Monique's favourite show.
Monique's favourite show, Behind the Camera. Monique's, yes, just like catfish. Yes, please. But people go to meet up with someone in a cafe or a restaurant or a bar or whatever, and they think, oh, am I actually going to meet the person that I think I'm going to meet? So the more steps involved before you meet them is probably a good thing, right?
Yeah, it stops you just filtering people based off like artificial measures like height and school and all those sort of things. Whereas this you can add like...
We do that with stocks though.
It adds a bit more depth because we're looking at people here, Owen.
Yeah, it's true.
But anyway, the better they make their apps and the more they add to them, the more people want to use them and are happy to pay for them because they're investing in their future and hopefully meeting the right person. So, it's really, really interesting. They've got a big court case that they've sort of settled on. There's a big financial settlement coming up. So that's nearly $500 million they've got to pay out in legal fees because there's a bit of backstory to that. But that's, I'd say, another known risk as well. And there's also a risk if people have less money to spend and they've got to cut back on discretionary spending, they probably go back to the free version of the apps
try their luck
and stop paying for it.
Yeah.
But I don't know. Everyone likes love. So people are probably happy to keep paying for things if they think it's going to work.
Everyone does like love, Kate. That's it. That's good. So this is, we're joking a bit here. Like we're having a bit of fun with this one. But the reality is that, this is for many people, this is a hugely important spend in their life. Like they might not want to spend the money, but they see it as necessary because they want to find someone, they want to connect with people. This is a great way to do it. So, that could be your investment case. Like your investment case could be, I think more people are going to meet online, and I think Match Group's brands are going to do more of that. And that could be the reason why you decide to research the company or whatever.
I mean, you can do a lot of research with this. You can download all the apps and create accounts on all of them.
You can write back to us and let us know which of the dating apps is your favorite and why.
Yes.
We would love to know.
You can try all the features.
In investing, we call that a
market
scuttlebutt.
Research.
Market research, boot leather research, or we call it like a channel check even. A channel check is where you go and you check out what management say. Like you could even ask people, we could ask people listening to this podcast, do you use it out of 10? How would you rate Tinder versus Bumble? And then you can do your own research and that's informing your investment.
Yeah.
So cool. Nice
there
one.
There you go.
Match
The
Group.
business of love.
Like it. Kate, you're very, is that ethical? I feel like it is.
I don't know, making people happy
You're making
eventually.
people happy with your
Awesome.
investment. You're supporting happiness.
As long as they don't just stay on it forever and they actually find someone, then it's doing its job.
Yeah, it is. That's good. Like it. Good outcomes.
The next one is a little bit different.
Okay.
In terms of less love, more...
Please don't say funerals.
hopefully not. Exploration.
Exploration. Oh, okay. That's okay.
Future focused. So this is a company we have done a deep dive on before for the Finance Podcast. It's Fortescue Metals Group, the ticker code FMG on the Australian Stock Exchange.
Fortescue.
Twiggy Forest.
Yep. We've talked about this a lot.
Digs things out of the ground.
Yep.
Puts them on trains, moves them to ports, ships them overseas. And is doing lots of different things in the future of energy. Twiggy's flying all over the world trying to make Fortescue future industries happen. And he's recently stepping back into the business. I saw an article the other day because CEO is stepping down, but she's staying on the board, I believe.
Okay, so this is a business, if you haven't listened to it already, the Australian Finance Podcast where we did a deep dive on Fortescue Metals Group, this is a business that is involved in iron ore, but it's got this other division, which you just mentioned, which is all about, renewable energy or at least like low-cost alternatives like green hydrogen, for example.
Yeah, and they're putting a huge amount of focus on that. They're trying to make them almost equal divisions of the business. So that's an interesting one to look at as well. And Dr. Twiggy Forrest, Andrew Forrest.
PhD of marine biology.
Yeah, he's just a fascinating man. We talked about one of his Boyer lectures. That's really interesting to have a listen to. And I just think what they're doing is really interesting. They're doing some good things for the future of energy. So I think it's a interesting look when you're looking through an environmental social governance lens, what they're doing now versus what they're hoping to do in the future. Yeah,
cool. I like it. So we talked about it's got big dividends because Twiggy loves his dividends. There's a book about Twiggy, by the way, which is fantastic.
Yeah.
I actually found that to be one of the most, I would say, encouraging and inspirational biographies in Australia for Australian entrepreneurs. So if you haven't already read that book, go ahead and look at it. It pays dividends. It is dependent on iron ore still because that's where almost all of its revenue comes from. And within that, it's dependent on China too.
Yeah, very concentrated revenue.
Yeah, so that's the big key risk. It's always been a risk, mind you. And with that comes a dependence on iron ore prices. So how iron ore prices set, basically supply and demand. If there's too much iron ore, like from Brazil or from BHP or Rio, wherever, the price will go down. It's supply and demand. But at the moment, iron ore prices are pretty strong and they're able to make huge profit margins because of that. And then they can recycle that money on the other side of their business.
Yeah. I just found the whole business fascinating. And since we did that deep dive, probably a year ago?
Yeah, maybe.
Slightly less. I've just been following the company. It's been fascinating.
Yeah, right. Okay. So that's Fortescue, ASX FMG.
That's the other interesting point. Like once you actually do a few hours of research into a company, you every time you see the name in the news or someone mention it, suddenly you have all this background knowledge to the company and you become a lot more interested in what's happening.
Yeah, because what a lot of people do, right, is they find out about a company and they're really overwhelmed at first, like, I'll never be able to understand this thing. But then they read the first 20 pages of an annual report and they're like, okay, I got it. Like the CEO just explained what they're doing and the chairman just explained what they're doing. And then the next time you pick up that annual report, you're like, oh yeah, I remember this. And then you see it in the news. You'll be like, oh, yeah, I know that. I know how that relates to this business. And you don't need to pick it up all at once, right? So that's a good point, yeah. What about number 3, Kate?
The final one is a bit different again.
Okay, a bit different again.
So it is a Australian investment bank called Macquarie Group. So most people have probably heard about Macquarie Group. It's you've probably got your big 4 banks and then Macquarie Group.
Yep. And what's the ticker symbol?
MQG.
So that's the code you need to put in
by heart on your brokerage account. If you're looking to add it to your watch list, it's on the Australian Stock Exchange as well. We'd probably put it into that blue chip company basket that we mentioned in our jargon buster. It's a large company. Everyone knows about it. It's been around for quite a long time. It has a pretty cool CEO, Shamara.
Yeah.
She's been running it for a few years now. Over 17,000 employees globally, and it actually earns most of its revenue outside of Australia.
Yeah, so it's different to all the other banks, right? Because the big 4 banks, ANZ, NAB, Westpac and CBA, they're basically all about mortgages in Australia and New Zealand.
Yeah, right? And they've had some failed overseas experiments.
Yeah, whereas Macquarie hasn't. They've succeeded overseas.
Yeah, huge employee base. I've known a lot of people that have worked there and hard hours, hard work, but they've got a lot of experience and have enjoyed it. And they do a lot of different things. So they'll do everything from home mortgages that you and I could go and get, but they do a lot of infrastructure. They do manage funds, annuities. They do lots of deals for big companies that are wanting to do mergers and acquisitions. There's a lot going on behind the scenes.
Yeah, so they do like what we would call traditional finance, or traditional investments in the industry. So they would do things like, consulting. They would help companies merge together or break apart, and they would earn a fee for that work. They also do something which is really interesting, and Raymond knows a lot about this, is they actually also have a big presence in financial advice and wealth management, and in particular in the technology side of things. So they have analysts and advisors that are very sophisticated software engineers that, so they build the software that their advisors use. And so that allows them to compete against other technology companies. So they're really innovative, even as a bank.
Yeah.
And that's what makes them so, I guess, successful.
Yeah, and they do a lot with high net worth clients in Australia and globally.
Yeah, if you bank with Macquarie, it's like the bank to bank with, right? That's kind of how it's known.
Yeah, they have some big offices in Melbourne and Sydney.
Yeah, they've got this beautiful office right in the middle of Sydney. You can see it from Martin Place. So, okay, then you had this theory about the logo, because Catherine and I have always known it as like the silver donut, because it looks like the logo is just a donut.
Yeah, so
silver.
I did not know the background of the logo until I was actually having a bit of a research on their website, but it's actually the donut is modelled after Australia's first official currency, which was called the Holy Dollar. So in 1813, Australia actually faced a currency shortage. And so the governor at the time, Lachlan Macquarie, now I've only just learned about all of this stuff, so I'm just regurgitating for you, but addressed this currency shortage by importing 40,000 Spanish silver dollars and punching a hole through the centre to create 2 unique coins. So you had the round one with the hole, and then you also had the small coin.
Okay, so you have 2 different. Okay, right.
Yeah, these 2 coins stimulated the economy and they addressed the shortage, and it was a symbol of innovation and ingenuity at the time. And so Macquarie are focused on being at the forefront and being innovative, so they did their logo after that. It's probably, I'm assuming Macquarie is also named after Lachlan Macquarie, the governor as well.
Yeah, okay, so Lachlan was a genius then. He brought 40,000 coins, brought them to Australia, made 80,000 coins by punching a hole in it and getting a small one in the middle and the big ring around the outside.
Yeah. I mean, I never knew about that. I don't know if I've learned much about Australian history before 1901. That's kind of when it started in school.
Interesting. Okay. So, that's a good point too. So he's basically brought these coins out. It stimulated the economy. And now when we look at the logo, we can think about that and not like a cross between Krispy Kreme and an investment bank.
Yeah, I didn't think they'd modelled their logo after a donut.
We never know. Who knows?
Macquarie's been around for a long time, though.
Yeah, it has. As I said to you before we started recording, they've recorded a profit for over 50 years in a row. So there's not many companies in Australia, or even perhaps throughout the world, that could say that. Yeah. So that's really impressive. So Macquarie Group, do you own shares in Macquarie Group?
Yes, I do.
Yeah, I do not, Catherine.
No.
How about Fortescue?
Yep.
Okay, no for me.
Nope.
No? Okay, and that's it.
I also think I own a little bit in Match Group as well.
You do? Yeah. Okay. Oh, sorry, we didn't ask that. Yeah, so I don't not own any Match Group. Do you own any Match Group? No. So
you need some love in your portfolio. What other company's going to give you that?
Coca-Cola?
Diabetes.
Okay, well, that's 3 fantastic examples.
From your non-analyst on the show.
From the non-analyst on the show, we have Match Group, a play on dating and love. We've got Fortescue, a play on iron ore and green hydrogen. And then at the very end, we've got the donut / 2-coin wonder Macquarie Group. I like it. So you can put all of them on your watch list. And they're all fantastic businesses, to be honest. Like if you look at the performance of these companies over a long period of time, fantastic performers.
Yeah,
and very
they're big
different
companies.
Too. Yeah. So you can go and investigate them. They've all got really interesting CEOs as well, including Shamara. Shamara, if you are listening from Macquarie Group, one of Forbes' most powerful women, apparently. Please come on now, podcast. Okay, so that takes us through Raymond, mine, and Kate. Now we're left with Catherine's 3 companies. So, Catherine, we're going to switch over to you.
Bring it home.
So the first company, probably no surprises here, but it's Apple. So it's a business that we all know and love here at Rask. Very big Apple fans.
Yeah, I own shares.
Yeah.
Yep.
I also own shares.
Okay, so that's 3 shareholders.
I own less shares than the cost of my device, though. So that's probably, I don't know what that means.
Okay, so Kate owns less shares. The value of Kate's shares are less than her MacBook.
And phone.
And
And
phone.
If you add
laptop.
mine up, that'd be the same thing.
Yeah, so if we
screen.
just spent
And
every
AirPods.
dollar that we spent on Apple
And
products
Apple Watch.
and we invested that in Apple, we'd probably all be retired right now. So that actually is interesting, Catherine, because then it brings us to like, why Apple? It's like the biggest company in the world. Why would we invest in it?
Power in Apple is the ecosystem. So, you've got the iPhone, you've got Mac, iPad, AirPods, Apple Watch.
Apple Watch right
Apple
here.
Fitness.
Yeah. Oh, yeah.
And then on top of that, you've got all the subscriptions. So as Kate said, fitness, there's Apple Music, there's iCloud, there's the App Store.
Mm-hmm.
It also makes money from licensing. So as Raymond was talking about earlier, how Google is the default browser. So they actually pay Apple it's estimated to be $15 billion each year just to be the default search browser on Apple.
So basically,
Bit of change.
so even though Google is super powerful, it still needs to pay Apple. So when you type in, Match Group in Safari, it comes up from a Google search engine.
Exactly.
Right, because then Google gets the advertising revenue. And it also means that, I'm guessing it also means that Apple doesn't have to compete against Google because Google would be scared of that, right?
Yep.
Yeah, cool. Okay, so that makes sense. So basically, there's 2 sides of the business. We've got hardware and software.
Yep. So hardware, on the hardware side, we've had the recent iPhone 12 supercycle with the new 5G phones. The new Macs and iPads have been powered by this really powerful M1 chip, just kind of changing the game here. And the wearables business, it's also doubled in 3 years, and it's nearly the size of a Fortune 100 business. So this
Apple Watch and related type stuff, if it was its own company, it would be like a 100th biggest company in the United States.
Yep.
Right. Okay.
Bigger than Fitbit?
Probably bigger than Fitbit. You'd have to say. Like Fitbit
Yeah.
wouldn't be in the top 100.
recently acquired by Google.
Yeah.
Oh.
There you go. So
New
Google
competitors.
bought Fitbit. Maybe it's an attempt to try and do the same thing. Yeah, but not as good. Let's be honest.
No.
We're all, other than Monique, who's behind the camera, doesn't have a microphone. She can't defend herself. We are all Apple fans here. Yes, we are. Okay, so the thesis then basically is, if I'm not mistaken, Catherine, is basically the hardware component. You know, people buy these devices and they start using things like iCloud. They start using Apple Fitness. And so Apple can make money from you two ways. You buy the product and you pay for the service.
Yep.
Right?
Yep. And above all else, it's just the brand, the power of Apple's brand.
Yep. Would you say that there's like risk for Apple from disruption or from, like, what would you say is the key risk to the business? Like, are there risks from, I don't know, regulation? Like what would be the key risk?
So the key risk would be just Apple staying relevant. So, consumers wanting to still buy Apple products and using their services amid competition.
Yeah.
That's one of them. Another one would be regulation. So as Kate said earlier, with the App Store, that's an ongoing kind of battle. So I think they charge around 30% of all...
Criminal
from your Match Group.
I own both, so I guess it plays on each other.
No matter who pays, you win.
Yeah.
And it's not just,
Capitalism.
so like say, if there are apps on the App Store that you have to pay for, so they get money that way. But also for those apps with in-app subscriptions, Apple also takes a cut. And companies are forced, to use to charge those services through the App Store where Apple gets a cut. So they can't go around it. So that's what the big battle is about.
So right, because this is one of the big games companies.
I think it's Epic.
Epic Games, which owns Fortnite.
Yep.
Because you can play Fortnite on your phone as well, can't you? Yeah.
Yep.
And that's free to play. But then if you want stuff in the game, you have to pay for things.
Yep.
And Apple basically forces them to pay through the app.
Exactly. Yep. You can't go around it.
Yeah, well, it's interesting because we've researched a company called PushPay, which does donations. And Apple has said, no, you can't donate through the app because they don't want money laundering to go on through the app. So that's like the one exception to this massive rule, which is developers must pay through Apple. So regulation, like they're basically making sure that it still remains relevant.
Yep. And at the moment, there's obviously supply chain as well and inflation risks.
Yeah. Okay. But other than so those are like kind of the business risks. And then obviously it just comes down to valuation. How much is the company worth, so on and so forth.
Yep.
Okay, great. So Apple, ticker symbol?
AAPL on the NASDAQ in the US.
Cool. So you need a US brokerage account to trade in Apple shares. One of the mistakes that I made when I first started was putting US companies into my brokerage account search thing widget and realizing that I couldn't buy any of them. But thanks to companies like Stake, Perla, Self-Wealth, not ComSec, those companies, you can do all of it in one account. So that's great. Okay. So this morning when we were talking about this, I said, you're going to go from one company to another. What do they have in common? And you said they both start with the letter A, and at least a ticker symbol. Which is your second company?
So my second company is Adore Beauty. So you've gone from this huge, established, powerful brand to a much, much smaller company. It's a lot more risky, but it's Adore Beauty. On the ASX, ticker code is ABY. And it was a recent IPO. I think about in 2020, so right in the middle of COVID. But it's the online only, so Australia's largest online only beauty retailer. So they sell, I think it's over 250 brands across like makeup, hair care, skincare, fragrances. And it was started by a lady called Kate Morris. So all the way back in 2000. She was working at university, she was working at a department store, and she recognized that a lot of women found the whole process very intimidating because back then there was no reviews, there was no product information. So you'd go in and you'd rely on the expertise of the person behind the sales counter who would often sell you a lot more than you originally wanted. So she set about to create a more powerful shopping experience. And yet she recognized the online opportunity well ahead of the game. So fast forward 20 years and you've got Adore, so around 900,000 customers.
So the story of Kate Morris is really interesting because we had her on the Australian Investors podcast.
Right, yeah.
We did a full interview with Kate Morris, and she described that it wasn't always smooth sailing, right? Over that 20-year period from then to now, there were stories of her crying in the car park with her partner as they were thinking, how are we going to pay these people? They had to form trade agreements with people with organizations like Woolworths, which then unfolded, and so on and so forth. So it wasn't just smooth sailing the whole time, right?
Yeah, and she's recognized herself that she was far too early on the online opportunity.
Meaning that she was thinking, online's this amazing opportunity, but it took many years to catch up. Yeah. So pop quiz. Do you guys shop with Adore Beauty? Do you buy anything online?
I buy things online,
but
but
Adore Beauty
I've shopped a couple of times. I know Catherine loves the Tim Tam it comes with, but I
do
do like the in-store experience at Mecca, which is a private company still.
Is Mecca? So here's my level of knowledge. Excuse me.
Surely you've bought someone a gift from Mecca, Owen.
I don't think. Wait, I think I've been to Mac. Is that the other one? Is that the same one? What is
No.
Mac?
Mac is makeup.
Well, that's where I've been because that's where I've got go-to products from before.
No, that's
No.
Mecca.
Oh my God, it's
Mac
Mecca.
does not.
No.
There's Mecca Maxima.
What?
There are different types of Mecca stores.
Yes.
Okay. See, and this is why.
If you bought
know
go-to
what?
skincare products,
You would have
you
bought it
did
from
not go to
Mecca.
Mac, you went to Mecca.
This has actually brought us to a fantastic point, right? Is if you look at the investments industry and the analysts in the industry, a lot of them are males like me who have no idea about this stuff, right? So imagine me going and analyzing this company, Adore Beauty. I would have no idea. I'd be like, yeah, it's this store. And you'd be like, I don't know, that's not the store. It's this one. It's an example of having a diverse analyst team. It's really important.
But it's interesting if you think it go-to. So if you go into Myers, which is a listed company in Melbourne, there is a Mecca store within the Myers, which is a different company, and you can buy go-to skincare within the Mecca store, within the Myers, which is owned by a different listed company. So
BWX.
many companies.
Yeah, so BWX now owns half of...
Yeah.
yeah.
So you walk into Myers, but suddenly there's 5 or 6 businesses all at play before you get to the product.
Yeah, right. And another one, Kate, I'll throw one back at you, is you could put on your sunscreen that you get from Adore Beauty. You could use your Apple iPhone, download Tinder, and connect with someone online. Who knows? They might even work for Fortescue Metals Group. There we go. Bringing them all together and back with the Macquarie Group.
But anyway, back to Adore Beauty.
Yeah, back to Adore Beauty.
I'm sure there's a few more fun things to tell us.
Well, one of the reasons why it's interesting is because the beauty industry is going through this shift to online. So in Australia at the moment, only around 11% of sales in the beauty industry are online. And that's much lower than countries like the US and UK, which are around 18%, and then South Korea and China, which are around 40 to 50%. So this was a trend that was happening well before COVID, and COVID's only accelerated this.
That's probably the key risk though too, right? For investors thinking about this, they think of Adore, they think during COVID, of course, it would have done well because you couldn't go into store. So you had to buy your makeup and your skincare online. So is that a risk that that doesn't happen?
For sure. Yeah.
Reverses?
So yeah, even now, so you're seeing that Adore quite many customers during COVID, and some of them have gone back to in-store, but it's still growing, and a lot of the customers are they're seeing the benefits of purchasing online, and they're continuing to do that.
Well, because that's interesting. Because I guess maybe if they don't even keep everyone, at least some of them they acquired, they would come back.
Yeah.
Yeah. Do they have any exclusive distribution partnerships, or can you buy the same things on Adore as you can buy any other website?
Yes, so that was going to be one of the risks here. So Adore does. I think they have around above 50, but they're all pretty niche kind of brands. Whereas you have something like Mecca, and they have like Too Faced, Urban Decay, Charlotte Tilbury, a lot of just big brands that you can only purchase through Mecca. That's one of the big draw cards there. Yeah,
right. So that if you want one of those brands, you basically have to go around Adore.
And you've got Sephora in Australia with stores as well now.
Yes, and they also have exclusive brands.
Yes, I have seen that brand around.
Well done, Owen. It's also near Myers in Melbourne.
Okay. That's probably where I've seen it. So I guess one of the things that I spoke to Kate Morris about was also the shift towards private label. Is that important to the company?
Yes. So they've been working on this for a while now. They're set to roll out their first skincare private label product. I think it's this quarter. So they haven't announced it yet. But yeah, they're working on just private label their own products. So I think skincare and then also hair care. And then they can they just get better margins for it. So they make more money from selling their own products.
Fascinating. Okay, final question from me on Adore Beauty. It's probably one for the room. Is makeup just one big Ponzi scheme? Does it actually make a difference?
One of our analysts said that a few months ago.
Yeah, he was like, to be honest, does any of it actually do anything?
Skincare, yeah.
They were using makeup-like products back in ancient Egypt. Do you know that?
I remember the eyeliner. I see the eyeliner thing on
People have been crushing up beetles and charcoal and making beauty products since the beginning of time, Owen. So I'm not sure it's going away anytime soon.
Okay. But so would you say that skincare, skincare is probably there. Kate Morris did say one thing. She said, even if you don't pay any attention to this, at least put on sunscreen because it will protect your skin at least.
Yeah.
So I guess this is a huge industry globally. I'm just mocking it, but I probably shouldn't be because it's massive, right? Yeah. So Adore Beauty is a play on skincare. It's got a pretty positive thematic or tailwind at its back, pushing it along. And it's not quite the L'Oreal or the LMVH or something like that, but it's not creating all the products, but it's selling them.
Yep.
So cool. Okay, that's a good one. Good one for your watch list. Number 3, Catherine, we've gone from Apple, which is the juggernaut, one of the biggest companies in the world. We've gone to Adore Beauty, which is an Australian company that sells skincare products online. What is number 3?
So number 3 is a company that you may not be familiar with. It's called Catapult on the ASX under the ticker code CAT. Cat.
Meow.
Yes.
Yes.
That's the one. And it's a sports analytics company. So you might not have heard of the company, but if you follow AFL, familiar with the Telstra tracker, which is the thing that shows you the heat maps of the players, stats like how far they've run, repeat sprint efforts, and things like that. So Catapult has, it's best known for this little GPS tracker that sits in a sports vest or at the back of a player's jumper. It just tracks a bunch of different data points and performance. So it's used across a wide range of sports. So you've got AFL, NFL, soccer, basketball, baseball, many others, and a bunch of just really high-profile teams like Real Madrid, Chelsea, New York Jets, and Boston.
Chelsea.
All using the products. So yeah, the idea here is that it's used to optimize performance of the players, but also maximize time spent on field by reducing injury.
Didn't like Raymond brought up PWR Holdings before, which does the cooling systems for almost every Formula One team. Didn't Catapult make an acquisition for the technology as well? You know how when you watch the F1 and it's got
Powered by AWS.
yeah, it'll say like
tire degradation.
that's the one.
That's
Yeah, or it might say like what's the Australian guy's name?
Daniel Ricciardo.
Daniel Ricciardo is, there's a 52% chance that Daniel Ricciardo passes Lewis Hamilton in the next 3 laps.
Yeah.
And that calculation and all those variables that are taken into account, that's created by a company,
SBG Sports.
SBG Sports, which Catapult bought, right?
Yes, correct.
So why did they buy them?
So Catapult also has a video arm, so a video solution
Right.
part of the business. So that's where SBG comes into play as well.
Right. So they've said, we have all of these soccer teams and we do all the analytics for them. Why don't we do it for F1 as well? And why don't we take that technology from F1 and try and bring some of that, like those calculations back into sports as well?
Yeah, and a lot of sports look to F1 as the leaders of, analytics and data.
Yep. So how does Catapult make money? Like how does it monetize like those, like the tracking and the wearables? And then, how does the business come together?
Yeah, so in recent years, Catapult has shifted to a subscription business model. So teams get the hardware, so the wearables, and then they pay a subscription, so a recurring subscription to access the platform and get all the analytics.
Yeah, cool. So when they report, I noticed this when they report, they have like the annualized recurring revenue is a figure that they quote, which is like the annual subscriptions that come through. They measure all of them. So you can track that as an investor. You can say how much revenue do they expect to generate every year. And the point there is like you want to keep an eye on like how many customers stay, which is retention, and how many leave, which is churn. You want the churn to be low and the retention to be high. So how about the management team? Do you have any insights on them?
Yep, so it's led by someone called Will Lopes. So he came from Audible, part of Amazon, and he's really just trying to transform the business. It was kind of known for poor capital allocation in the past, so it spent money on kind of underperforming businesses. So now he's just trying to right the ship. Something to be mindful of is incentives. So he is, and the rest of the management team is paid quite a lot without kind of long-term incentives that align with shareholders. But so far, he's really kind of focusing on the core business and trying to integrate the different parts of the business together.
Because Kate, that's something we talked about in our 5-part checklist is the management team, right? So having a good management team that not only is good, but also is working for the long-term benefit of all shareholders is really important. Yeah. Having heard Will on calls, he sounds very enthusiastic and he's taking that kind of Amazon approach to like long-term success of the company.
Something he's also really passionate about is predictive analytics. So at the moment, it's all about descriptive, so what's happened, but the future is, what will happen, what could happen.
So that would be like predicting, like in the example of that F1 where there's a 52% chance that Daniel Ricciardo is going to crash around the next corner or something crazy. In that example, taking that example and then putting it into soccer or putting it into the basketball or something like that, where you can, there's a 20% chance LeBron James is going to score 3 threes in the next quarter or something like that.
This not take some of the fun out of the game if you've got all these stats and analytics?
Some people love the stats though. Some people like froth over stats. Like
I know you play in your fantasy football league. You love the stats.
We have
Call me out.
We have a sport like a tipping competition, and Kate and I are holding up the ladder, aren't we?
Well, I have
Monique's number one actually behind the camera.
I have not
Killing
voted
it.
for any companies in a few weeks.
Voted.
Voted.
Companies, what do I say? Football teams.
There's a tip.
I'm getting very
It's
confused
also
here.
a tip, not a vote, but that's okay. We are getting there. So just to recap, we've got Apple from you. We've got Adore Beauty, and then we've got Catapult. So all companies that kind of involve technology, but they are different and serve different end users. We've got like the mass market with Apple. Then we've got, just like the skincare and beauty market, e-commerce. And finally, we've got sports teams, like sports analysts and those types of things. So that's kind of rounds us out with our 12 companies.
Yeah, a lot of different industries we're playing in.
Yeah, I wonder if like someone could somehow tie all of them together. So you know how you said before, like you gave an example, maybe in my example, maybe you could take a piece of iron ore to your Tinder date, which you connect with via Apple. And if you get really hot,
I
you
think
can
we're
have
stretching here.
a PWR cooler just by your side, just to something like that. I don't know how MFF Capital ties into any of it, but that's okay. So there are so many great companies you can see that are available throughout the world. And you gave that great example, Kate, of basically everything that you touch. Like if you go into a Myers and you buy go-to skincare products, who is involved in that? We've got BWX, which is on the ASX. We've got Maya. We've got all the companies that are involved in that. And that's a competitor of Adore Beauty. So then you think, okay, everyone's lining up there. Maybe that's not good for Adore.
Even just as an experiment to try to expand your mind to the fact that so many different companies are around, walking into a Myers or a Bunnings or what are those big DFO or whatever you call them around, walking into a big department store and actually just looking around and starting to go, what is this company? Okay, is this listed? Or maybe it's owned by another listed company. And if you just walk around and spend an hour and have your phone out and do a bit of Googling at the same time, you'll start to realize there are so many different elements at play and all these companies coming together as part of a bigger picture. And it really starts to, even if you're just walking down the main street in your capital city, search some of these companies up. Maybe they're not listed and they're private companies, but still really interesting to have a little bit of a look into all of it and how it all fits together.
Yeah, it is fascinating. And if you're looking in the store, turn the product upside down or around the back and have a look at which company makes it.
Yeah.
You never know. They might be traced back to a company that's on the stock market. So
look at what payment systems the staff are using.
Yeah.
Maybe they use a HR. You could even ask them what HR software.
Are you using Salesforce to track customers and monitor all of that? And chances are they probably are, to be honest.
Yeah.
So when we watch the Australian Open in the past year, you would see a Salesforce logo on the court. So what is that company? What do they do? It's not all about the Rolex in the corner, but there are so many different companies that you can invest in if you have access to the share market, in particular the Australian and US share markets together.
Yeah, just being a bit more curious, I think, and keeping your eyes open when you're walking around in the world, and you can start to see lots of different companies and potential ideas for you to research.
Yeah, and one thing that I really want to emphasize from this discussion too is we haven't come here and said buy this, buy that. That's not our intention with this episode at all. What we're here to say is basically this is the opportunity that you can kind of take advantage of. You can go out there and explore all these companies. And if you do want to put money behind them, you might just start with, a few $100s behind one company, and you might still have like your core portfolio that's diversified, low cost for the long term. That's, dare I say, serious money, air quotes. And then you can explore some of these companies as you learn about investing and so on and so forth. Finally, I will call out the Investor Bootcamp Training Manual. Totally free. It's a Google document that I put together. It's available through the Australian Investors podcast, where Raymond had also appeared and talked about some software tools to use for investors. So go and check that out. There'll be a link in the show notes. It's a great chance for you to take it to the next level. Otherwise, Kate, Catherine, this was heaps of fun. Thanks for joining me.
Yeah, thanks for listening, everyone.